All right. Good afternoon. My name is Chris Konetsky, and I'm the group publisher for Business Publications, which produces Business Record and DSM Magazine. We're so grateful that you are taking time out of your day today to come here and learn and prepare your business for the year ahead. And we're excited to jump in and start unpacking what's ahead for the economy in 2023. Now, I had an intro all lined up to tee up the discussion today about the economy. But before we get to the program today, we felt it necessary to pause and acknowledge the tragedy and violence that not only hit so close to home yesterday, but also in two separate events in California over the past few days. Yesterday's shooting in Des Moines took place right down the street from our office at the nonprofit organization Starts Right Here, and it claimed the lives of two students while leaving the founder and CEO, Will Holmes, in critical condition. If you aren't familiar, Starts Right Here is a nonprofit designed to serve youth and aims, among other things, to connect business leaders and community leaders with young people in the community in an effort to help them reach their full economic potential. And by extension, of course, help our community reach its full economic potential. As a result of yesterday's shooting, two of our students are not going to reach their full potential, and quite simply, that's tragic. There's no good way for us to turn from tragedy and start talking about federal interest rates and the economy today. But we're here, and this is the reality, and that's the reality right now. Today, we just ask you to keep the victims and those affected in your thoughts, and of course, pull for Will to have a safe and full recovery. At the Business Record and DSM Magazine, we are here to serve you and the business and your community. No matter what economic conditions or challenges that come our way, it has been and will be our mission to inspire, elevate, and celebrate our communities, and most importantly, keep you informed and positioned to succeed. And that, of course, is why we're all here today, to help give you a peek and a window into what's ahead in 2023 and beyond. We've got a fantastic group of panelists, and they're going to help you digest what to expect in 2023 and beyond. And we're going to begin our discussion shortly. As we begin our program, I want to encourage you to begin your lunch as it is served. To minimize disruptions during the discussion, we've asked the Sheraton staff not to clear plates until we've concluded our program, so please enjoy your meal. Before we dig into our discussion today, I want to introduce today's sponsors who help make this event possible, and we'll also be honoring our CFO of the year. Our first sponsor and our presenting sponsor for more than a decade is Raymond James. Founded in 1962 by Bob James, the company set out to make a different kind of financial services firm by focusing on the clients first. They now have they have thousands of financial advisors and experts around the globe. And here with us today is Jerry Bozen. He's the Vice President of Investments for Raymond James. And before we hear from Jerry, please take a look at this short video.
While you may not be a pediatric surgeon volunteering in topiary talents at a children's hospital, your life is just as unique. Your Raymond James financial advisor gets to know you, your passions, and the way you live so you can live your life. That's life well planned.
Please help me give a warm welcome to Jerry Bozen.
Good afternoon, everyone. It's great to see everyone. Just want to say, well, they said I could talk for 2 or 3 minutes, but maybe it'd be good to following up on Chris's comments if I could just take a few minutes or a few seconds, maybe some of my time, and just encourage you to have a thoughtful moment of silence for everyone who's recently died from gun violence, and maybe think about what we can do about that. Thank you. It's my privilege and pleasure to welcome you here today. very briefly what a privilege it is and how honored we are at Raymond James to sponsor this event. Like to thank Deb, Tom, Eric, Nate, and Debbie for taking the time to be here and sharing their expertise with us. Like to thank the Business Record for all they do. I think it's wonderful to meet the people that are carrying on the legacy that Connie started. And I think personally, I just think the Business Record is a tremendous resource for Des Moines. And we're very, very lucky to have that publication and that organization here in town. And just like to join everyone in offering my congratulations to Steve. And again, thank you for the opportunity. We intend to continue to sponsor this event for as long as we're welcome. Thank you.
Thanks, Jerry, and to the entire Raymond James team. We appreciate the sponsorship as always and for allowing us to continue putting on this type of event. Our supporting sponsor today is Security National Bank, which takes a tailored approach to helping their clients plan, protect, and grow. An integral part of this process has been by building meaningful, lasting relationships while offering trusted financial advice to their clients. These personal and community connections have been the focus of Security National Bank since its start in 1964. This is the second year Security National Bank has joined us as a sponsor of our economic forecast. Please welcome John Jacobson, Vice President of Iowa Trust Administration and Wealth Management Director for Security National Bank.
Thank you very much, Chris. Delighted to be here today. I want to echo not just the thoughts of us at Security National Bank and Security National Trust, but our prayers for God's mercy, his blessings, and his healing in the midst of this tragedy. It's great to be with you today. I'm an Iowa boy. I grew up in Cedar Rapids. My parents were from Dubuque and Clinton. I went to law school at the University of Iowa. I just completed my almost 7-year term in the Iowa legislature, back in the private sector full-time, living in Council Bluffs, but we have decided at Security National to double down in Iowa, to build more jobs in Iowa, to bring more people into Iowa. We have a dozen branches. We are now at Jordan Creek. We are in Council Bluffs. Our trust division is working in 99 counties with the court systems. And my marketing department prepared some remarks for me today, but some of my friends here who remember me in the legislature know that I always wrote my own material or spoke from the cuff. Now, here's what my marketing department wanted me to say today. Investment and insurance products are not FDIC insured, not a bank deposit, not bank guaranteed, may lose value, not insured by any federal government. Here's what I want to say to you. It is a real joy working as a fiduciary trust officer. Many organizations are very good at wealth management in terms of picking and choosing investments that are prudent and appropriate for them. What gives us pride in a 24-member trust shop, a traditional trust shop, is that we are federally chartered and regulated as trust fiduciaries. So with a team of lawyers in-house and investment professionals, we take care of those children with special needs who may be paraplegics or quadriplegics, managing long-term their assets and making sure no predators invade that. We work with young couples with life insurance so that if God forbid something happened to them, there are life insurance proceeds that will be there long-term to raise those children and to educate those children. We help people with estate administration and probate, because as I always say, if you don't like one of your kids, name them executor of your estate. It's a tedious process, and we do all the nitty-gritty work and help the folks when they're at their most vulnerable, tragic times. As we know, in Iowa and in the legislature, we tackle elder abuse very strongly. It's prevalent. A trust officer protects especially affluent family members from predators, not just predatory suitors or creditors, but family members. And also, a trust officer works a lot with unique assets, farmland. Sadly, we see a lot of family fights right now. Often the courts bring in trust officers to run the business, to mete out the distributions, to make sure income comes in, tax compliance, while the family's settling the fight in courts. So it's a really great honor. This family is here to stay. The Landons from Security National in Omaha, we're now in our 4th generation. We have a tremendous operation also in Dallas that is rivaling Des Moines right now. So Omaha, Council Bluffs, where I live and work, Council Bluffs is the heart. Our 2 lungs that are billowing right now are Des Moines, at Jordan Creek, and at Dallas. So thank you. It's great to be integrally, fully part of the community. I'll be working here 4 days a week in Des Moines. Look forward to seeing old friends and meeting a lot of new ones. Thank you, guys.
Good afternoon, everyone. I'm Susanna DeBaca, and I am the CEO of Business Publications Corporation, which is the parent of Business Record. And we are very pleased to see all of you today. This is just such an incredibly packed room. After a couple of years of pandemic, I cannot even tell you how heartening it is to see so many people come out, not just to learn about what's happening in our economy and our community, but also to honor folks like our CFO of the year. We're actually very proud to say that for more than 10 years, Deloitte has been the presenter of our Chief Financial Officer of the Year awards. That's an entire decade. The Deloitte philosophy is that the beliefs, behaviors, and fundamental sense of purpose underpins everything that they do. For more than 175 years, they've continued to help their clients realize their ambitions, to make a positive difference in society, and to maximize the success of their people. So today, presenting the CFO of the Year award, I'm very happy to introduce you to Chris Tierhark, who is Audit and Insurance Managing Director at Deloitte Tax. Let's give her a round of applause and thanks to Deloitte.
Thanks, Susanna. I wanted to start by just echoing the heartfelt sentiment of Chris and the other presenters in terms of the recent tragic events in our community. I do have the privilege of leading our audit assurance practice of the Deloitte Des Moines office. And as a sponsor of the CFO of the Year award, it is my honor to welcome you to today's event. Each year, the Business Record sponsors the Deloitte CFO of the Year award. This goes to an often unsung hero who demonstrates outstanding performance in their corporation in terms of corporate financial stewardship. This year's honoree, Steve Boll of AccuMold, a global manufacturer of microparts, is just such an unsung hero. Steve began his career at AccuMold 22 years ago, joining the company at a time when the president and CEO, Roger Hargens, says they were literally and figuratively moving the company out of a garage onto a global platform. Steve was the right person at the right time for the company. We needed a leader with the right skills and experience to keep our complex financial and accounting systems sound, Hargens said. Steve's advice and influence were instrumental for the company to keep us fiscally strong and to help me as president and CEO balance our goals and financial stewardship. Since those early days, Steve has helped oversee significant growth at AccuMold, including a stock buyback from then shareholders, 3 expansions of their building, including a sterile clean facility for medical manufacturing of microparts. And this has really helped propel AccuMold onto the international stage. In addition to his work at his company, Steve is a respected leader in the community. He currently serves on the Ruth Harbor Ministries Board, is on the Association of Business and Industries PAC Board, and is on the District 5C Judicial Nominating Commission. Previously, he also chaired the Ankeny Area Economic Development Corporation. As stated by Hargens, for me personally, Steve has been a perfect partner for all these many years. He has complemented my leadership as I've worked to stretch and grow our organization. Deloitte, in conjunction with the Business Record, is proud to recognize Steve Bohl as the 2023 CFO of the Year.
Well, I will tell you, first thing, I want to do before I do anything else is thank Deloitte and the Business Record for this award. And really a thank you to many supporters who provided letters of recommendation. I don't even know who you all are, but I know there was, several. As I reflect on this recognition, what came to mind is that it's really based on relationships. And that's really kind of the focus, for my remarks. Number one is my relationship with God. I look back over time and decisions I've made, with career changes, things we've done, in the business. At the time, I didn't recognize it often, but it's kind of like the hand of God was there leading me. And, that's probably most important. But second is my wife of 46 years, Carmen. She is really, well, we got married when we were 20 years old. And for anybody that has kids, you look at that and it's kind of like somebody asked me when, my kids were approaching 20 and I was like, no, that's way too young to get married. But we did. And we had, and probably the key thing then was that Carmen decided that she would be willing to, stay home and nurture our kids and raise them. As I was working, and it really allowed me the freedom to, I had time, to be able to do what was needed when needed, and through those years. Later on, she, after our kids were a little older, she started her career, in the political realm, served in the legislature for 10 years. And, a few years later, she served as chief clerk in the House of Representatives. So hopefully that was, kind of some payback, in supporting her through that. I'm pleased to have two of our three children here today. My daughter, Beth Strobel, who is here from Kansas City. She has two girls, she and Blake. And then my younger son, Michael, who currently serves as Governor Reynolds' senior legal advisor. And they have a grandson and a granddaughter they've given us. So I want to thank them for being here too. Another person that I really, have to give credit for in this whole nomination process is Kim Butler-Hedigus. Kim, I have known, we've known each other for years, and really we've never had, any business, dealings, but knew each other and, kind of stayed in touch. And this past fall, an opportunity presented itself that fit, and we were able to do that. But I just know that she invested a lot of time in this whole nomination process. And, I really want to thank her for that. Last, I want to thank my business partner, Roger Hargens. As I, look back, on that initial interview, it's kind of like at that point in time, what I was really thinking is I wanted to be the owner. I wanted to be the CEO. That's not what this situation was, but, someday I'm going to find that. Well, anyhow, the more I look, the more it's kind of like I had trouble finding an opportunity I thought was going to be good. And honestly, I didn't have a ton of financial, money just waiting there to, go into something. But as our relationship developed, I look back and it's been several years ago now when I started recognizing this is the best situation for me. And I think it's the best for Roger. Really, we complemented each other, like Roger's remarks said, and really together, we were, accomplishing more than if we were either one of us probably on our own path. So anyhow, it was one of those where, a lot of things have happened. It's taken a long time, to get where we're at, but it's been a great journey. So again, I just want to thank you, Deloitte and the Business Record for this award. Thanks.
Congratulations again, Steve, and talking to your owner. Sounds like big things are still on the horizon for AccuMold in the future, and we're excited to see the company continue to grow here in the community. All right, we're ready to jump into our discussion today, and there's, of course, no shortage of topics to dive into. You're seeing our panelists here making their way to the stage with inflationary pressure, potential Fed rate increases, continued labor market pressures, global challenges, and of course, a little closer to home, not so small game of chicken with the debt ceiling. And of course, I'm sure there's some whispers you're going to see woven within our discussion today about that, the word recession. And we talk about it, it seems like every year at this, but I know it's on everybody's mind once again. So we've got a great group of panelists, and I'm sure they're going to touch on these topics and more as they help us wade through what's to come in the year ahead. With us today, we have Don Coffin. He's the CEO and president at Bankers Trust. We can give him a round of applause. Let's go ahead. Don was looking a little nervous there, like he wasn't going to get a round of applause. So Debi Durham, she's the executive director of the Iowa Economic Development Authority and the Iowa Finance Authority. A round of applause for Debi. Eric Lohmeier, he's the founder and president of NCP Inc. Tom Rietz, I'm going to see if I get this right. The Soumyo Sarkar, professor of finance and developmental executive officer for the University of Iowa Tippie College of Business. Now the question is, now Tom, did I get that? All right, I'm good. I'm 1 for 1, but now I'm going to mess it up because I already forgot from before. So lastly is Nate Schelhaas. Got it. All right, 2 for 2. Senior Vice President and Head of Life Protection Solutions for Principal Financial Group. Just recently, some of the world's best and brightest CEOs and economists met recently at the Davos, Switzerland for the World Economic Forum's annual event. The mood, as the Wall Street Journal put it, was somber. The pessimism, though, might have been ebbing. In that same story, the ever so optimistic Larry Summers, the former Treasury Secretary, said he had become less pessimistic about the Federal Reserve's actions and now believes that the economy is unlikely to experience massive financial trauma in the months ahead. That's good. You don't want massive financial trauma. Davos attendees, Larry said, are sort of daring to be hopeful, but not entirely convinced of being hopeful. Thought it was a way to put how everybody's sort of feeling right now. So to start things off for the panel today, we're going to put you each on the spot. In 2023, I want you to answer the question, do you think the Iowa economy will A, improve dramatically, B, improve slightly, C, remain about the same, D, regress slightly, or E, regress dramatically? And then, of course, tell us why you think that is. Nate, we're going to go ahead and start with you.
Yeah, thanks, Chris. And thanks for allowing me to be here today. I'm excited about this. Half of you got the benefit of not being able to see me. It's a win, and I apologize to the rest of you on the this side of the table. So I would say, and I don't have the same pedigree when it comes to the economic forecast as these folks to my right, but I do think it is going to regress slightly. I think it is going to go down, maybe not as much or as far as we thought it was earlier. I guess it'd be later last year, but overall a slight regress. And the perspective I hope to take to this this panel is really what are business owners thinking? What are they feeling? What is their outlook? And I will tell you that a significant portion of them do expect a recession to come in 2023. Now, the magnitude of that still uncertain. As we go through this panel, I can share a little bit about what they're thinking, some of the things they're doing. Hopefully that will resonate with some of you. We perform a survey quarterly, a well-being index of business owners. So I can talk about that as we go through this. But I think these folks to my right probably have some math, some stats, some predictions about what's going to happen. So I will allow it to move down the line here.
All right, thank you, Nate. Tom?
Well, when I saw this question,
And Tom, why don't you go ahead and move your mic, bring it nice and close up to you.
nice and close.
Yep, you got it.
When I saw this question, I thought back to my first job at Northwestern and one of my senior colleagues, Gene Lerner, who ran a fund. We taught on the same night every week, and he would come by my office every week and ask me, is the stock market going to go up or down? Is unemployment going to go up or down? Is GDP going to go up or down? And it didn't take me long to realize that the right answer to all those questions was yes. So the thing we have going forward in the economy is an unbelievable amount of uncertainty as we've taken a look at forecasting things like GDP, taking a look at forecasting inflation, interest rates. What we see is an enormous range of possibilities. Just last week, we forecast the higher education price index for next year, which we use to try and help set tuition. And ancillary to that, we end up forecasting CPI, and the forecasts that we get out of the models that we've been using for many, many years range anywhere from minus 0.27% to 4.8%. Why? Because there's an unbelievable amount of uncertainty. We still don't know how we're going to come out of COVID as an economy. Personally, what I'm seeing where I work, what I'm seeing in Iowa City and Cedar Rapids, are real challenges as the workforce tries to come back. The workforce is smaller than it used to be. The employment rate is about where it was before COVID, but participation is so low relative to where we were before COVID that it's hard to find workers still. And we don't know what's going to happen as workers come back into the workplace. What I fear is that for business to operate, we need to be able to trust each other. And we seem to have lost that relationship skill to some degree during COVID. And we certainly have lost it in today's political environment. What happens with that will determine what we're going to be doing as we go forward in the future, I think.
Thank you, Tom. And Eric.
Tom, that was a really good answer. Hard one to follow. You know, you had the A, B, C, D, and I see really it's really, the way we're looking at it is very much a two-tiered economy going forward. You know, I'll start with, you know, probably the negative. I think it's decidedly a D in highly leveraged cyclical industries. And for a lot of people in that room, it's not going to be a popular guy walking out of here, but I see probably a pretty long-term downturn in real estate development that goes from, you know, obviously residential all the way through to commercial, including warehouse. I think warehouse is we're going to see some real softening in warehouse in 2023. Because I looked at the statistics, and of 685 million feet that were in the ground in 2022, over 70% of that was spec. And then you have Amazon, literally Amazon subleasing space. So it's going to be a hard place to hide when you have an interest rate scenario that went from 0 to 4.5%. And you've either got a perm finance or refinance, whether you're in a residential situation or commercial. So that one I think is actually going to be tough for you know, for a while. But then I look at what I call, you know, some other less cyclical, one being infrastructure. So we've got $1.5 trillion of federal committed dollars, which have a 2 to 3 times multiplier for 10 years. So you're looking at plus or minus $4 trillion going into this economy over the next 10 years, both through that federal funding and the private multiplier. I think a lot of the labor is going to be really strong from that infrastructure build. You also see it in commodities, including ag. And so then you'll have all the ancillary effects, you know, the ag manufacturing, the services that go around that, you know, the war in Ukraine just being one piece of that. It's kind of harder to do some trade. You're literally rewriting the trade rules globally. So you're going to have some really pretty strong parts of the economy and some pretty weak parts of the economy. But overall, and this is kind of where Tom's at, as far as labor is concerned, and I'll call it kind of bluish collared labor, I think the unemployment, I have a hard time seeing that moving up too fast. So from a kind of a day-to-day, you know, making a living, having a paycheck, it's going to be a different kind of a C-. That's my answer.
Thanks, Eric. Appreciate it. Debbie.
Well, first of all, good afternoon and congratulations, Steve. You certainly model servants leadership. So my friend, congratulations to you again. All right. So I am the eternal optimist. So I said remain about the same, but I digress between that and regress slightly because there's certainly a lot of headwinds that we're facing both nationally and international that we have no control over. The reason why I settled on remain about the same is because one, I'm going to give a lot of credit to Governor Reynolds. I do think she managed the pandemic extremely well. And I think with every day that passes, we see that. So our economy is very, very strong. And it's diversified. The other thing I think has been done with the ARPA dollars, like other states, we actually invested it in some strategic investments that will serve us well into the future. But manufacturing, which is our largest gross state product right now, is extremely strong. We're seeing some relief in some of the supply chain issues that we've seen in the past. I mean, it depends on what the supply is, but overall, we're seeing an easing up of that. Our exports are up in 2022 over 2021, which is extremely with China now not abandoning their zero COVID policy. That actually serves us well as they are our third largest trading partner today. So, you know, I believe we're going to fare better. I think we're in an enviable position that's going to weather the storm much better. And I do believe that we're already seeing recessionary signs. We've seen it for a long time. But again, I was in a really good position.
Thank you, Debbie. Don.
Well, as I read the bios of the folks on this panel, I couldn't help but think how this reminded me of when I was a dessert judge at the Iowa State Fair. So I was a food judge. So I go up there and I'm the dessert guy. They claimed me the dessert guy. And there was others from, you know, the entree and appetizer, et cetera. So there's a whole panel and they started individually identifying their own bios and their own resumes. And it started off as chefs. Some of them were culinary instructors, et cetera. And they finally get to me. And all I could add to the whole conversation really was, you know, I'm Don Coffin and I've been eating for 55 years. So
Best judge.
with that, that also explains, I suppose, how I got on this panel. I'm not sure, but I would say that all I really know is really feedback from our clients and customers. And I'm going to go with, I was going to say stay about the same, but I'm going to say increasing slightly. And I say that because there's a ton of optimism in our client base and a ton of optimism with our customers, and they see their backlogs as still being there and their pipelines are full, and they're just now seeing some relief from the labor issues. For one reason or another, their percentage of unemployment in their own industry or their own company has dropped, and their supply chain issues might have freed up just a little bit. So I'm thinking just based on that we're going to increase slightly. I know there's a lot of headwinds. It's mostly fear. I think that's the headwind. So with fear, changes people's attitudes, changes people's behavior, I think too. So there is some worry out there. Certainly housing has been a factor, but I also think there's a lot of positives with some of the infrastructure bill that's going on, and that'll help Iowa. I think the ag economy is very strong, and the agribusiness world is pretty strong as well. So farmers are going to, I think, see a good year. There's a lot of input costs that have increased on them as well, but certainly their commodity prices at the other end, I think, have made up for that. So I'm going to go with slightly increase.
Well, Don, thanks for doing business for 55 years. That's good. We appreciate it.
I'm older than that now.
Oh, okay.
Let's go with 62.
That puts you in business at about 7, which seems right. Okay. All right. We're going to stay on the topic of banking here to start, and because it's some of our most recent indicators that we have from some of the larger businesses in the country. So nationally, large banks have been setting aside money in recent quarters to cover potential losses on their loans if the economy weakens. The 4 largest commercial banks reported mixed fourth quarter results last week, which again, I think points perhaps, Tom, to some of the wide variations in where people are at. There's just wide variations and projections here. There were wide ranges of profits and of losses and gains, of course. And so according to the most recent Iowa data from the third quarter of 2022, Iowa Bank's net income was down 6.3% from the same period in 2021. That decline was due, according to Iowa Bankers Association President John Sorensen, who I saw here earlier today, was due to an increase in provisions set aside to protect against future loan losses and ultimately the industry's recognition of the risks related to persistent economic uncertainties. So I share that because I'm curious, Don, if you could talk a little bit about that behavior and what you think that's showing here in Iowa for banks to be taking that type of approach, and what your thoughts are around that spot.
Well, there's way too many bankers in the room for me to be overly truthful on this answer. So, no, that's not true. Well, I think what's going on with the bank income is twofold. One, I think most banks had their loan portfolios mostly fixed and their deposit portfolios mostly variable. And so when rates drop, your margin drops. So they didn't make as much money. There was also a factor that's going on right now. Again, I think banks put money away in their allowance for one of three reasons. Either they're growing, they have problem loans, or fear. And again, with the fear part, I think is playing most of that right now. And so they are anticipating what might happen with their credit card portfolio or with consumer debt generally, because the commercial side is reasonably solid in most banks' portfolios. So I think that's the majority of what's happening with the Iowa banks. I think Iowa banking in general is in a really solid footing. Problem loans are down low across the board. Past dues are way down. I think all the banks are in good from a capital standpoint. I think we're in a really good spot. So I don't see much issues on the banking side. I think the opportunities that present itself in Iowa are numerous, and I just think that they're still in line for a good year. And I'm not sure I answered your question, but is that pretty close?
I appreciate it.
Okay.
Yes. Curious from the rest of the panel, when you look at some of those national banking trends, what do you think is behind some of that? Again, I've heard the word fear a couple times. I'm curious if that's primarily what's that, or should we read deeply into that? But there's such wide variations of performance. I'm curious how people are reading into that.
I'll just start, and you alluded to it, but I'll be a little more, I guess, obvious. Banks are really slow to move, as if you just found this in 2022, slow to move on deposit rates. But on the asset side, on the investment rates, if a bank has liquidity, they can move really fast. You know, when the Fed funds rate, for example, goes up from effectively 0.25% to 4.5%. And so what I think you have is, looking backward from a bank profitability standpoint, you had a really, really fat spread in 2022. And certain banks kind of move faster than others, but I think that kind of tightens in 2022. 2023. So I think that could be a headwind. But on the flip side, and I'll support Don's comment here, by and large, we work with a lot of Iowa banks. I think they are by and large pretty conservative. So I don't necessarily see a huge kind of reserve. Even if they add to reserves, I don't necessarily think you'll realize those losses over time. But you are going to find that in something called the leveraged loan market, which has been like rocket fuel for private equity. So,
Debbie?
Well, and I'm not going to speak to the banking industry, but what I do want to do is talk about the capital industry right now. What we're seeing is, particularly in spaces that I was really well positioned in, the bio stuff and energy, a ton of venture capital chasing it, right? So we're seeing a lot of deals coming in, venture capital coming into the state for the very first time, more so than we ever had before. So that's, I think, encouraging to me. And I think some of those, like particularly in the bio space, it is really somewhat recessionary proof. As I would say, so is advanced manufacturing, just at least in the investments being made.
Nate, I'm curious, from some of your work with businesses, with the research that you all do, what maybe advice or thoughts you might have for working with banks at this period of time in this environment?
Yeah, the first thing I'd say is, when I think about banks, and the only recession that we've really gone through, a lot of us is that 2008, 2009. And that caught a lot of people by surprise, the severity of it and the amount of capital left around after everything went to hell in a handbasket. So I do think banks are being somewhat, maybe a little more conservative, more cautious. And that's one of the first things I'd say is, when you see other organizations and business owners, I know there's a lot of you in here, when you see other organizations doing things like setting aside cash reserves or building those up, that's the things we're hearing from business owners, is they're getting ready for whatever the scenario is, a slight downturn, a bigger downturn, driving down expenses. building up their cash reserves. Those are the things people are looking at doing. And there are other things that business owners can do today to help them get ready for a recession. Secure a line of credit because you don't know when you might need some additional capital. Diversify your revenue. You know, the pandemic taught us anything. It's that necessity is the mother of innovation or invention, and business owners found ways to keep generating revenue in ways and forms that they didn't think about before that. And so sit back. I know so many of you are so busy, but give yourself some time to sit back and think about what other avenues of revenue do I have? Is there a different way I can do this? Are there other people I can reach out to? Strengthen your key relationships. You know, just about every one of you has key relationships you work with, key contracts, whatever they are, work with your key partners and fortify those. And then the last thing I would say is one of the biggest asset business owners have are their employees. Listen to them. What's on their mind? What's important to them? Sometimes there are benefits that don't cost you $1, right? Take your pet to work day. Work remotely. Well, you know, those are things that have come out of the pandemic somewhat, but think about those. I'm sort of in that middle age and I'm the guy that loves to go to the office. I'm in there just about every day. I like seeing people, but there are a lot of people that really like working from home. And if they're doing it well, I don't need to make everybody work like me. I don't need to have everybody in the office at the same time. We can do things that are flexible, that benefit our employees, that meet them where they are, that don't cost a lot of money. And when you think about going into recession, those type of benefits can have a meaningful impact on your employees and not hit your bottom line.
Don, back to you for a second. When you think about your bank's approach to lending in the year or two ahead, what advice would you give if people are looking for business loans, if they're thinking right now, what's your projection look like in that space?
Well, I think, well, my projection is everybody wants a lower rate on the loan side, but a higher rate on the deposit side. But, you know, I do think it's a good time to be cautious. It's a good time to stay fairly liquid, keep your investment short, because I think near term is uncertain, but I think long term, the economy is going to stabilize and rates will drop.
Can I add one thing to that?
Absolutely.
Here's a positive. You have a 5-year and a 10-year treasury right now at 3.6 and 3.5 respectively, which is over 100 basis points lower than the Fed funds. So what we're even working with clients, and we're trying to find out what debt can you term out today. And if you think about it, if you go over the last 50 years, we might have had 3 years of 3% 10 years, you know, so you're within 50, 75 basis points of a really low average. So there is opportunity for a good balance sheet. You know, you can get a good spread from Don for sure. And I tell him it came from me. But I think there's a real opportunity for business owners to take what they can term, or even to look at an acquisition or capital expense and innovation, whatever, and borrow off that 5 to 10 year spread. And you're not too far off the best rates you've had in the last 10 years.
I want to turn to Tom here and talk a little bit about inflation. You mentioned it in your opening remarks. U.S. inflation hit a 41-year high of 9.1% in June, but has since eased and dropped to the most recent increase of 6.5%. That's still well above the 2% pace that the Fed is aims for, but also below the 7.5% mark in January of last year. So curious if you could talk a little bit about when you were looking at those projections, how you're thinking about inflation for this year.
Well, sure. I mean, there's a range of things that are going on. I mean, there were supply side issues. There was demand side issues. Interest rates have been going up from the Fed. But if you look at the long run yield curve, like you were just saying, after a year, the yields start dropping dramatically, which would be an indicator that we weren't expecting long run inflation. If you look at futures on Fed funds rates, even start dropping after next June. The futures rates may cap out at 4.5 to 5%, but they're expected to drop again, which is also an indication that we're not expecting the inflation to last in the long run. If we look at forecasts going out 1 year, there's an enormous amount of uncertainty left, like I said at the beginning. But if we go out to 2 years, the inflation rate forecast we did range from 1.7 to 2.9%. So getting close to the Fed funds target, at least from the forecast that we have now. Again, still a great deal of uncertainty.
So when we start talking about the effects of that on businesses and WSU kind of leaning in, any thoughts on how Iowa specifically is positioned in that space?
Yeah, I mean, and to talk about inflation, I mean, first of all, there is a stickiness to inflation that we never talk about. And these wages are still going up tremendously, right? You're still seeing rents and some of that. So the other thing is we're not really seeing, and certainly the Christmas season didn't show it, but I guarantee you the first quarter of this year is going to show there is the health of the consumers out there. We're seeing credit card debts rise. We're seeing people be employed, but many of them are going back to dual jobs to make ends meet. And so I am just saying, the Feds is, even though I think sometimes the stock market thinks they can manipulate the Feds, I'm not seeing it. I think they are truly on this path to raise rates. And I think, and of course, what's happening in the housing market. So I think inflation is going to do a lot more damage. And yes, it's coming down slightly, but again, I do not see the Feds changing course. And I think the story of what it's really doing consumers out there is yet to be told. And we're going to start seeing it this year.
Nate, I'm curious from a small business perspective, is there things businesses should be thinking about in an inflationary environment? Most businesses have not been in this environment for a long time. So curious how that's shown through in some of your research.
Yeah, so that is the number one concern for both business owners and their employees is inflation, followed closely by recession. So that's number one and number two for both business owners and their employees. That doesn't always happen that they line up like that. So it is a joint problem that can be solved. And again, you go back to, if you think about inflation, what are the things you can do? Can you secure financing if you think rates are going to go up? What are the things you can do now to protect you in an inflation environment? There are going to be things, sometimes cost of goods are going to go up. Can you raise your own prices? And we're seeing some business owners starting to raise their prices to account for that. So they are taking steps. Again, they're sort of guarding against a recession and inflation at the same time. Maybe they go hand in hand by building their reserves, decreasing expenses, and in some cases, raising prices of what they offer or what they produce.
Don, you already alluded to your long-term experience. So you might have been through some periods of time where there has been inflationary pressures, I assume. Is this right?
A little bit. Yeah.
Okay. I wonder if you could share maybe some lessons from that period of time, or if you think there's lessons that maybe apply to an environment that we're in right now.
Well, I bought a house in 1983 in Waterloo, Iowa. And I think I was the only one in Waterloo, Iowa buying a house at that time because I assumed a loan, which that doesn't happen anymore, but maybe it will again. But I assumed a loan of 14.5%. So that was 1983, and I thought I was stealing because the rate was 16 or 17. So things are different, and I think just a perspective here. Interest rates in the 70s, I think roughly started and ended at about 7.5%. In the 80s, it's roughly from anywhere from 10% to 18%. I think the high was 21 at one time from a Wall Street Journal Prime. And it was 21 for almost 2 years. But so the 90s were 8 to 10%, and 2020s were like in the 6 to 8. So it's come down now in the 2000s, since 2000. And so we tend to think of it has to stay down. So we're not in a high rate environment today, relatively speaking. So I think it's going to be higher than it was 2 years ago, rolling forward for a few years, but I think it'll stabilize and gradually come down from where we are. That's how I believe it to happen. I think the Federal Reserve is going to raise rates for sure in a week or so. On February 1st, they're going to raise them probably at a lower pace than they have in the past. At least one, maybe two, maybe three, and then it'll stabilize and probably come down from that particular point. And that's kind of what the Federal Reserve predicts. We got to remember too that what the Federal Reserve predicts doesn't always come true. I think in 19, they were predicting what rates would be in 2020, and all of them had flat. So that didn't occur. It dropped to zero. So things change and things come in the way of all predictions. And so I think what Nate said, be prepared, is probably the best advice, and that's probably what I would give too. Try to be prepared, and what can go wrong. Inflation's only bad if it doesn't affect all parts of your business. It affects your sales as well as your costs. Then at a same percentage, then you end up net being about the same, right? So what can you do to fix the lower part of your business and change the revenue side to being positive. So that's my advice.
You know, one of the things I find fascinating is I've been working for a little north of 25 years, all of them in the insurance industry. I have only ever seen interest rates go down until recently. And so not having had that same experience, it's fascinating for me to hear some folks that have seen it. And so thanks for that.
For being old, yes. You're welcome. Yes.
Code breaker.
Eric, I wonder if you could talk a little bit about where maybe some of the effects of rate increases and here in Iowa, maybe what you're seeing. You work a lot with mergers and acquisitions, and just curious what you're kind of seeing here in this environment, maybe have seen, and where maybe might be going.
So I'll try to be brief, but I'll give you two examples. One, for a lot of people in this room, or your kids, or you're moving or retiring, or, we basically had a truly once in a lifetime opportunity, whether you were buying our house or refinancing a house. A lot of us literally would have a 2 handle on our mortgage, like 2.125% on 15 years, 3% on 30. And it's not that the rates weren't like 18% in the 70s or excuse me, the 80s. It's the fact that someone borrowed $300,000 at 3%, just real simple math. That's $9,000, right? $9,000 a year. You double that mortgage rate to 6%. That's just in interest. That's $18,000. So if you think about that excess $9,000, that's like $750, $800 extra per month on your mortgage payment. So that's going to be painful. I'm not saying it's not 12. Well, it went from 3 to 6. So it's sticky. It's going to be sticky for a while, and it's going to be painful. Think about that on steroids in commercial real estate, by the way, when you borrowed 80% on $30 million. So that's kind of where I was going with that, but all is not lost. And that's where I was. And this is, I'll kind of go back to the fact that as a business, and especially like a business in Iowa, or what I'll call lower middle market businesses, and we define those a company between 20 and $200 million of revenue. That's that decision. And you talk to 10 different people, you're going to get 10 different answers, but that's ours. And if you're in that stage, you could go out and do a $50 million, facility or an acquisition of a business. And you could go to Don's banks, and there's a lot of good bankers out in this room. And whether it's a consortium of banks participated or whether it's, direct, you could go borrow $30-40 million on balance sheet, spread off of 3.5. Probably best they're going to do is 7 years. So there's the answer. You can spread off a 7 year. You might get quoted off a 10, but I say that at 3.5%, you're a good borrower. You can borrow at 130 bips. I'm giving you guys all kinds of good stuff today. 130 over 3.5. So you can go borrow at 4.8% and fix that loan for 7 years. The best you were going to do at the best part of 2022 or late 21 was like 3.3. And if your project doesn't work at 4.8 versus 3.3, you should have done it anyway. So there's some real positive things too. If you're a good credit, responsible, you got some great plans, you can still do it. But there are going to be sectors, like I said, whether that's commercial real estate or residential, et cetera, that are just going to take some time to really, really work through.
Any other thoughts on federal interest rates before we move on? I want to move on. We've kind of danced around the topic of recession, and I'll use a quote here from Jamie Dimon recently, JP Morgan's CEO. He says it may be a mild recession, it may not be. So I think
That's profound.
exactly.
That's what we said.
Yes. So I'm curious, when you start thinking in that way, how should we be thinking about? I think Don, you're saying people are taking actions to prepare out of fear, but it happened in the past. It happened so fast, right? I think Tom, I can't remember who we were talking to before here, but if you can predict a crash, there's not going to be a crash. So I'm curious how should we be thinking about the year ahead as far as hearing the word recession? And I'm curious if anybody wants to jump in.
Well, I'll start, I guess, but a recession is really, first off, there isn't really a recession if everybody has a job. So I don't believe that can exist. And if it is a recession, it can't last very long. I just feel like the unemployment rate being low and the jobs being plentiful and people still looking to hire indicate to me that, at least in Iowa, if we do have a recession, it's not going to last very long. So and what does the word recession mean? It really is a big word that scares people. But at the end of the day, it's really about your company and your family and your household. If you have a job, you don't have a recession. You're moving forward and growing and going. And if your company's moving forward, you're doing well, right? So a recession's a mathematical kind of statistic and not necessarily the end of the universe. So let's not be as fearful of what it's called and just worry about keeping your own house in order, and then we'll all be fine.
Other thoughts?
Yeah, let me take a crack at this. So yeah, a recession is possible, right? And in Iowa, I think we have a great opportunity to invest in industries that would be resistant to a recession. And in particular, because of government incentives right now, there are industries that are particularly good for us that would be resistant to recession as well. You know, if we think about the kinds of things that are education, healthcare, food, and agriculture, and in Iowa, especially, we have huge opportunities in energy to be able to make investments that would help us weather any recession that comes along. And if we, are smart about the way that we as a state make policies to invest in industries like this, then we'll weather the recession if it comes better than most.
This one's actually really going to be brief. I think it's going to be a margin recession from a business perspective. And when I say that, I don't necessarily think it's negative growth or negative GDP, but what we, by and large, and I'm overgeneralizing here, but you go into the pandemic like in March and the world stops. I mean, everything just crashed, right? Well, from a M&A perspective, a business perspective, we still realize people need to eat, trucks need to move stuff. There was a lot that was happening, had to happen. People wanted to redo a house, buy a new one, and the economy really snapped back. Late 2021, 22, we all know what that was like. And what happened is your input costs, we'll call it labor, they didn't go up immediately. People were literally like fearful for their jobs for about 9 months as your revenues were cranking, and you got busier, so you charged more. So your profitability went way up at 21. You saw a lot of that 22 for a good part of that. Well, then labor is really not, they're not dumb. They can look in Google or Indeed or whatever. And the wages started to go up because we were growing and we needed help. And that labor piece really snapped through, and it's a lag. And so what you found in 22, labor really kind of caught up with that extra revenue, with that extra margin, and it's still kind of catching up. So what I think is we were frankly, literally, we were too fat, and we had a very healthy margin for a couple of years, and we're giving that back. So from a Wall Street earnings perspective, you'll see it this year. That's what's happening. Your cost inputs are delayed. Your revenues aren't growing as fast, or maybe they're even negative a little bit. And it's a profits recession. But to Don's point, which I underscore, our unemployment is so darn low and it's structural. I think it's structural. I don't see, to your point, most people, households thinking, oh my gosh, times are so bad. So I don't think it's going to be that bad.
Yeah, and I agree. I think it's going to be very shallow in Iowa. There's certainly some signs that we are going to see some recessionary pressures, but it's going to be a shallow one, I believe. And I think it goes back to, again, the investments that have been made in infrastructure. When I say infrastructure, housing, we are preparing, we have an agenda of growth in the state of Iowa, a competitive tax structure that was changed last year, the investment in broadband and childcare, all these things, but position Iowa for growth that will serve us well. And again, the diversity of our economy. Tom's right. When I said there's a lot of money chasing bio right now, in particular, and energy in the state, and I was well positioned, better than most, to really play in that arena. So it'll be shallow.
Tom, I wonder if you could talk a little bit about what maybe folks should be looking at on some of the indicators as we kind of go through the year. I know you all are looking at things as relates to inflationary pressures. If something started to go off the rails, what should people be looking at?
If something started to go off the rails, that's a great question. As you and I talked about earlier, things that make things go off the rails, things that cause a crash, are sort of inherently impossible to predict. Because we could predict them, of course, like a stock market crash. If you knew the stock market was going to go down tomorrow, what would you all do? Yeah, I'd sell today, so that means that means that the stock market crashed today. So it would have already happened, right? If we could actually forecast it. So you know, the things that will drive us off the rails are an inability to, the things that worry me are an inability to get our workforce, you know, all moving in the same direction. Our inability to do business contracting, especially international business contracting, if you know, we fail to trust, you know, other companies to deliver on contracts and things. And I think that, you know, we could go off the rails if you know, we really do default on the debt because of the arguments over the debt ceiling. I think we face some challenges in the state forecasting our own state revenues from a tax perspective, because the tax codes have changed so much that, you know, all the forecasting we've done in the past is sort of out the window, and that could throw us off the rails if it drives us into a fight. So I think from a policy perspective, from tax perspective, from an international contracting perspective, you know, there's lots of things that could go off the rails. And I hope that we are smart enough to be able to look at those and realize that they can cause real issues and solve our differences and come together on things like passing and increasing the debt ceiling and such.
Eric, you're always good for giving me a nice worst case scenario. Could you help us out here with some things that if things were to not go right, where would we see that popping up at?
So I'll call it labor inflation is still real. It is. It's getting supply chain. Last year we saw that loosening up, you know, and it's a little spot here and a little spot there, but it's not 15 of them at the same time. Labor inflation is still real. I think it's slowing down. The rate of change, the rate of change is slowing down on that labor inflation. But I do think the key risk to me is the Fed got so far behind the inflation curve when it was on the way up that the Fed, they have this example in the 70s where Arthur Burns got behind and then, you know, oh, the economy's slowing down, so let's cut rates again. And then you went to, you know, hyperinflation. And so I think that is so ingrained in the Fed's mind that I really do think the market is missing this. I don't think we're going to see a cut in 2023. And I think we're going to be at least at 5%. Now, if inflation is stickier and they're looking at a lagging indicator of that, which is, you know, late inflation, what we know is what happened yesterday, then the Fed kind of keeps going, and that could be really bad. So you kind of hope they do cool off a little bit, because I think it does need to get a little time to season, but they've been stubborn. And Debbie's point earlier, I don't think they're going to let the stock market scare them into a rate cut in 2023. And Wall Street does expect that today, very much so. And so do the forward curves.
So the concern for us in Iowa is the same concern we had pre-COVID. Iowa has a population problem. So let's talk about workforce. Like if you go to IWD's website today, they'll probably show close to 100,000 job openings, and there's like 40-some thousand on unemployment, right? And I would tell you that IWD only has a fraction of the jobs that you all could actually hire for. They're just not listed. Right? We still are not at the labor participation rate we were pre-COVID, which was 70.4%, second highest in the country. And we've got too many, you know, you got young men, 25 to 34, sitting on the sidelines. What the hell's that about? Right? And then you have this max. I mean, they need to find themselves back to work. I mean, you know, and then you have this mass exodus of retirees that have left, because in Iowa, people worked longer and COVID changed that. I thought we would start seeing some reverse on that. And so far we really have. I thought we'd certainly see it when their 401ks weren't as healthy, but we really haven't seen them find their way back either. So it's still that workforce piece. And if, you know, we're going to see higher unemployment on the national level. And again, on the national level, when they talk about the job numbers, they're still not factoring in part-time jobs, which people can't live on, right? Or again, people that are doing dual, you know, have two jobs. So it's not as healthy of a picture out there, even on the employment side. On the supply side, right? The demand is still extremely strong. So we have to do things differently. And Nate, you said it. I mean, companies are, whether it's remote work or whether it's flex scheduling, and we're even seeing flex scheduling on a manufacturing floor, which I see Mike Ralston over there. I never thought I would see that, right? Where they're saying we're going to run production 3 days a week, you know, 24 hours. So people are having to make those adjustments just to attract workers. And in this remote work, to a certain degree, is here to stay. I think you're seeing that begin to reverse too, because of culture, right? You can't build a culture if nobody shows up.
I'd be curious, Debbie, if you're seeing anything around remote work for outside of Iowa. So I work with or have worked with folks who have been hired by companies out of New York that instead of paying, New York cost of living salaries. They don't have to do that. They pay more than an Iowa cost of living salary or a salary adjustment. And so they're somewhere in between. So people are getting paid more than they get paid to go into the office here, less than they get paid if they went to an office in New York, but they're allowed to work for a company in New York out of their home. Do you think that is affecting it at all?
Yeah, I mean, actually, we're beginning to see that. And I think it's a great equalizer for rural Iowa, particularly with the investments we're making in broadband. You could run the world from anywhere as long as you are connected, correct? And so it's not unusual for me to go into these very small communities and they're doing something, some kind of major community investment, right? And there's young people that are leading it. And I can tell you this example in Mount Ayres, Iowa, when I got Molly's business card, it was, I'm an executive with Cisco out of California, right? So it is actually working. I will even tell you, we've had to change the way we look at incentives. We're still not going to give incentives to a company that's employing people in California, but we're not tying employee numbers now to a place, right? As long as the employees are in Iowa somewhere, we're going to count it. So it really is changing the way we even do business. And I think that will continue. Yeah.
Debbie, do you think there's an opportunity? A lot of the big tech companies have been laying off folks. And
Yeah,
so
big time.
I've got kind of two questions there. One first for you is opportunity there for Iowa companies to be looking at that specifically?
Yeah, we actually have a really strong tech economy here, and I do think there's a great opportunity to seize upon that. And again, getting back to that infrastructure investment that we're making. So I see that as a win-win for us. And again, a great equalizer for rural Iowa as you see people are coming home because they want to be closer to parents with grandkids or aging parents on the other side. And so we're beginning to see a real shift there.
So anecdotally, I can tell you a few things that I've heard recently is that their salary expectations for that tech community haven't changed a bit. And so they still are going up quite quickly. Maybe more and higher qualified candidates, though, are showing up probably for the reason you indicated.
Yeah. And I do think that's a sector you're going to continue to be remote. I mean, there's still going to be those jobs that you're going to just, wherever you can get them, you're going to get them because they're so specialized. And that population, I think, will still remain remote to a large degree.
So seeing those large companies tech companies primarily laying off folks, I'm curious, is that something that causes alarm bells to be going off? Is it something that you're going, hey, that's pretty well in one sector and we shouldn't read too much into it?
I think it's a sign of things to come as far as where you're going to see the volatility and jobs. And I do think it's going to be more, and these are terms that are pretty old, but people get them, a little more white collar, kind of officey versus blue collar, because we're talking about structural labor problems. But when you're a tech company, this is a really kind of an easy example. And you ramped up your employment by 55% over 2000, late 2021, even into 22. And now you're seeing like people aren't just, thankfully working from home all the time, or, it's getting somewhat normalized on kind of how people are living in their lives. It's more services and travel versus goods or whatever, and less gaming, for example. But these tech companies, ramped up and kind of assumed this growth curve was going to stay, higher for longer. And they're basically looking through their whole organization and they're like, man, we went up by 50%. Even if they cut that by 10, that's pretty significant from who was employed at a high paying job and who isn't. And so I don't think that's just tech, because if you think about it, and I think both of you guys have mentioned, like, well, companies are going to have to be really, efficient about their costs and really kind of look at that cost line. The biggest cost for most companies, especially kind of service industry, is human. It's labor. And so I think people are going to really hold on tight to those folks that are really hard to find, electricians, plumbers, construction, you name it. And there's probably still more opportunities for them, but I think it's going to be like, wow, we're not growing as fast. I don't need as much HR. I don't need as much onboarding. I don't need as much training. So it's all of those things around that. So I do think that's where you're going to see it probably continue. And then what does that mean for Iowa? Financial services. You had a market correction last year, 25-30%, depending what asset classes you were in. That's 25 to 30% less revenues if you're making money off of your assets under management. You don't think Wall Street firms are going to expect you to hit your earnings regardless? Where do you cut? People. So it's going to be two-tiered.
Yeah, I'd be curious what you're hearing from businesses around the state and if there's any thought in that space? On one hand, we're talking about the participation rate, and the other hand, we are talking about layoffs potentially.
Well, I can tell you what industry is doing. Industry is going to find a path because they always do, business and industry, and you're using technology to do a lot more. Again, we're changing employment policies they may have never thought of before. They're doing it now. So they're doing what they need to do to be able to continue to navigate this. So but people are cautious right now. I mean, they're gonna hold tight. I mean, there's still a lot of cash sitting on the sidelines. And I think what you're gonna see, at least based on our portfolio on the manufacturing side, is it's all being done and creating more digital plant floors because they have to, right? To be more efficient, to compete globally. And so you're seeing those kind of investments, which is why we invested very strongly in Industry 4.0, along with, our friends at Cirrus and ABI. So that's what you're beginning to see for industry. But business and industry will always find a way. I think during the pandemic, we learned that about every sector of the economy made that pivot pretty well, including healthcare, I would say. I think the only industry that didn't was education, and that was very unfortunate. But
So I want to take an opportunity here. We've talked a lot about some of the things that people should be concerned about, and I promise we're going to talk some opportunities here next. Just before we go to that spot, is there anything we haven't talked about that our audience should be hearing about and maybe should be keeping in the back of their mind?
Yeah, I'll maybe share one thing that we've heard through some of our surveying is what are employees worried about? And it's also an inflation, it's also recession, but then it goes to the cost of healthcare, it goes to mental health, it goes to those type of things. So if you're wondering what your employees might be thinking, if you haven't talked to them, those things seem to be front and center. And then the other thing that we're hearing from business owners, that if there is a recession, and this doesn't really contradict what Eric said, but kind of the last thing on their list of things to do is to cut salaries, to cut benefits, or to even cut the employer paid portion of a benefit, for example, healthcare. So again, if you're a business owner and you're wondering what your employees are thinking, first thing I'd encourage you to do is have a conversation with them. Second thing, there's a few data points for you to latch onto if you like.
It's interesting when we're looking to place students. We're still getting enormously high placements out of our program, but I can tell you the students that are coming through that are going to be our employees in the future don't want a job anymore. In fact, they don't even want a career anymore. What they want to be able to do is make a difference in the world. This is changing the kind of things we're doing in education, and it's going to change the pitch that you're going to have to make to the employees as you move forward as a business.
What other things should we be considering that we maybe haven't talked about yet?
The only thing I would add is, housing. I think I was here last year, and based on the data that we saw, we still needed 61,000 units, and that's across the spectrum, everything from supportive housing for homeless all the way up to market rate. Our new data points, which is actually incredible, because based on building permits and things and again, infrastructure investments, both by the legislature and ARPA dollars, and just the private sector stepping up, I think it's closed down to about 42,000 that we need units by the year 2030, which I'm very, very confident that we can get to. The areas, though, are the most difficult areas to serve. So what is that? It's now the 30% and below LMI, which is very low income, right? That's that real supportive services, or it's truly the market rate and still trying to bend the cost curve on construction, which is why that industry really needs to look at technology too, whether it's 3D printed houses and buildings, which is coming, right? I mean, it's not where it needs to be yet, but it is coming. We're going to have to continue to do that, because unless you're at a certain level in that market rate, it's going to be very, very difficult to meet that need. But at least we're showing progress on that, Chris, which I think, again, which is a key strategy, because we've got businesses who can't grow because there's nowhere to house people in their community. And so at least we're seeing a light in that sector, which is very encouraging.
Any others? One last one that I want to make sure I get in, since I didn't get the question about the coronavirus back in 2020 is the debt ceiling. We, we've seen that come up a number of times, and part of me goes, is it worth even asking about? And then part of me thinks it's negligent not to ask now. So would anybody like to comment about what we should be watching in that situation to see if there's going to be effects here back in Iowa?
Seemingly short term, the debt ceiling, they have to lift it, and they have to move forward. So I don't think there's really a choice. It's just the bravado going back and forth. But a longer term is we have 32, 31 trillion of debt. And now the interest rate moved up so repaying that is trouble. And that's not a problem unless other countries stop wanting to invest in America. So as soon as that happens, then we do have a problem. So I think we have a bigger picture there. Ultimately, it's going to come to the doorstep of ourselves, but so we'll have to figure it out in terms of balancing the budget at some point and moving forward.
This should be about as easy as working across the aisle of any subject matter, the full faith and credit of the United States government. I beg you to call your legislator, your congressional, I don't care where you're at on the political spectrum, and say, hey, something that's really important to me is the full faith and credit of the United States government. No more bullshit politics on this one.
All right.
My perspective is it could be worse. Imagine if this was before 1917 and we had to approve every single bond issued by the Treasury by Congress, which happens hundreds of times a year, right? And so it could be worse. Now we just argue about it once every few months, right? But we do have to actually manage to lift it if we're going to maintain, operations in the country.
Is there a point where businesses should be paying more close attention to this going forward? I'm not in that space to know whether that's something we need to be watching.
I think you're right. Call your legislature and say, figure it out.
That's all you can do.
Yeah, well, the debt ceiling is one thing, but I mean, and I think, and again, it's going to get passed because we have to do that. There's no other path forward. I think what you've seen playing out is just the thing we overspent during COVID. There was a time where stimulus was needed, but we are way past that, and we're still seeing stimulus that we can't even use, and that created a lot of these problems. So we do have a spending problem in the United States, and I think we do need to call that into question about we've got to put some constraint on this. And so I do think those are valid conversations to have. At the end of the day, the debt ceiling is going to get approved.
So Debbie, I totally agree with you. I have a spending problem in the United States, and like 85% of that is between defense, Medicare, Medicaid, and Social Security. So then the next question is call your legislator, have your own single conversation on which one of those to cut.
All right. I promised we would get ourselves out of me asking negative questions and some questions about optimism. Debbie, you're never short on giving us some good optimistic things. What are some things about the Iowa economy that you're bullish on for the coming year?
Well, first of all, what I'm very excited about is we're beginning to meet our housing needs. I think that's great. We're making a real stride on childcare. We had lost 33% of our childcare facilities in the last 5 years. We're beginning to see that change. We're seeing a realignment of global supply chains and parallel supply chains, which is going to serve us extremely well. So a lot of foreign direct investment. We're seeing, again, the automation and digitalization of plants and moving into Industry 4.0. That's exciting. And so, I mean, again, there's a lot to be optimistic about, particularly where we sit. Our portfolio today, the projects that we are actively working, in fact, I had a conversation with the Department of Commerce yesterday, and he said, tell me that again. Our portfolio is $18.5 billion of projects that we're working. And I would handicap those anywhere from 50% and above that we could actually land. All manufacturing, energy, and bio.
What's driving that growth in that
Supply
space?
chains, they need to resource coming back. They need to invest in their plant floors. And right now, I mean, again, we were ahead when we talked about, we own ethanol and biodiesel, and now challenging ourselves to think like a petroleum company and looking at either new plant molecules or harvesting chemicals from that. Everything that's done that we source for petroleum eventually can be done through this green fuel stream. And we are ahead of that. And we're finally seeing those building block chemicals come forward because now it actually makes sense because there's so much money chasing it right now. And so that's the direction of people going because of these really strong carbon neutral goals that companies have that they need to meet.
I'm curious with the loosening of some of the policies in China, which is of course a trade partner. What are you seeing in that space? Is it their opportunity in that at this point?
Yeah, I mean, most people are trying to get out of China as fast as they can. I mean, as far as, they're looking for more stable governments in which to do business with. And, there is, I mean, listen, there's some threats. I mean, the posturing that's going on with China and Taiwan should concern us all because of the amount of product that comes out of Taiwan. The USMCA renegotiations coming up, that's actually been really good for us. So that's a little bit of an unknown. So there's that. But overall, again, the things that we can control, I think, that we're in, it's somewhat are controlling our own destiny. We're in a really position of strength.
Other panelists with something that maybe you're feeling bullish about as you're looking forward.
I have to actually, I have to talk clearly. I have to echo your sentiment on energy for sure. I mean, I don't
You
care-
said energy?
Energy, yes. I don't care what your stance on global warming is. The fact that it's an issue in the world creates an enormous opportunity for us in Iowa. We are well positioned to capitalize on it. And it would be an industry that investment would pay off in, and it would be one that's relatively recession proof for us as well. And you're right on housing. From a social perspective, investment in affordable housing is an enormous value proposition. The question is how to align the incentives so that individuals who are investing in the housing can make a go of it as well.
Yeah, correct.
And once we have those two things in place, then we can move towards technology, we can move towards healthcare and bio, and all of that can fall into place for us.
Other points of optimism?
Yeah, so of the companies we surveyed in 2020-22, or nearly 2/3 of them experienced economic growth over the last 12 months. So that is really encouraging, and over half of them are excited about and optimistic about the next 12 months, even in light of the economy. So I think that's a really good telling indicator of the small business sentiment there.
What do you think? What do you think is driving that? We've just talked a lot today about this kind of both directions, right?
So I think a lot of them have made it through the pandemic. So that's one thing. And they've looked, okay, if I've made it through that, I can make it through anything. There is a recognition that there is inflation out there, is recession, but I have a chance to see that coming, and less so than I did in 08 or 09, and less so than I did a pandemic. And so I get a chance to do some of those things I mentioned earlier, to find a letter of credit or line of credit, to build up some reserves, whatever it is. I have a chance to do that now, and I can respond instead of react to what happens. And so there's a chance to plan that hasn't been there historically.
And of course, 2022 is record number of business startups in the state of Iowa, that at least that we can record. So
I think from, and from an Iowa perspective, we're in a great spot. I think the ag industry, insurance, finance, all doing very, very well. I think we have a large number of the dollars we're talking about from the government is coming in form of new roads and new bridges and things. So we'll get some Iowa impact from that. I think we have a great spot for other companies in other states to move into, because we have a lot of, we have no sale or use or property tax on some of the machinery and equipment. We have great rail systems. We have great transportation in general. And so I think we'll be in a good spot to be a winner in terms of a state versus state competition. So I just think we're in a good place.
Eric, anything positive that you're looking at?
I mean, I think frankly, 2/3 positive as far as Iowa is concerned. And I told ag and commodities we talked about earlier. We also are heavy logistics, transportation. That might be a neutral. Industrial services, I think that's a slight positive. Niche manufacturing, a lot of that does support kind of the ags and commodities. That's positive. So I actually think for the rural, and I don't want to just totally draw a line in this rural versus urban, but I think the rural economy is going to be pretty resilient. I think we're going to have some hiccup. We are. I mean, let's call it spade. I mean, Wells Fargo mortgage gone, effectively, candidly. That's not, I think that's the first. So I think our urban centers are going to have some issues as far as what we were kind of talking about, that white collar versus blue collar. But Iowa to me is like 2/3 pretty positive.
And one last question for you, Eric. When you look at businesses that might be looking to be selling in the coming years, what's the kind of your forecast look like in that space?
Yeah, that's a great question. Thanks for teeing it up.
Mm-hmm.
I'll go back to that 2-tiered. We just actually wrote something and published about this, but there's a definition a little specific to our firm, but industry, which we call high quality companies. And what that basically means is sustainable growth, either stable and or improving margins. And I mean, it's a pretty simple definition. And what I just talked about, kind of the 2/3 of what I just described about as Iowa's economy, are the 2/3 of industries that are actually going to see both valuation and desire for their businesses, if you're a seller, as good as they have been really in history, which is really the last couple of years has kind of set records on multiples and valuations. And I say that because it's also simple. There's a, I don't want to say it's unlimited, but there's a huge amount of supply, and that's like green money, dollars, 2 trillion just in between private equity and venture. And that's liquid equity. So that, you could leverage that at 2 times even, that's 4 trillion. And then you think about corporate balance sheets, by and large, generally healthy. You've got more dollars chasing, frankly, lesser quality assets. Okay. So if you're kind of in that zone where you've got growth, doesn't have to be Herculean either, growth, sustainable margins. There's a few other factors that are pretty important. Those are 2 big ones. You're going to get, kind of a top tier valuation on that succession. On the flip side, the other third is going to be we're seeing it. If you have some issues with revenue side, certainly margins compressing, you get hit on both sides. You get a lower multiple off of a lower cash flow. So there's going to be some time to work through that for some of these industries that we've been talking today that might be a little more challenged.
Thanks, Eric. Appreciate it. Before we finish, I'm going to give each of the panelists a chance to give a final closing thought while they think about what they want to leave you with today. I want to share a couple of things with everybody here as well. First, we, of course, had a great discussion today in this week's business record that's on your table. You can find a great story about our CFO of the Year Award winner, some additional comments from our panelists, and some comments from community leaders that I've seen here in the room as well about how they think the economy is going to be faring in the year. That's, of course, in your mailbox last Friday. If you're not already a member of the Business Record, we'd love to have you as a member supporting us and getting the weekly Business Record as well. You can sign up for that at businessrecord.com/membership. In addition, if you enjoyed today's event, we did talk about labor. We've got a great Power Breakfast event that's coming up, our first one of the year. We're going to be talking and diving really into not so much the high level of what's going on with labor, but truly trying to play a role here in helping us and helping businesses find additional pools of labor and finding ways to make sure that you've got access to the employees that you need so that you can continue to grow your business. And we're going to be discussing some really creative ways that companies are finding workforce, and registration for that is open at businessrecord.com/events. In addition, our sister publication DSM Magazine will host the Home Design Awards on February 28th. This event's going to offer a great opportunity for you to see some of the best in home design from a variety of categories, and that's going to be at the Hoyt Sherman. And our next 40 Under 40 event, that is going to be on March 30th. We're going to be announcing the honorees live on our Facebook page on February 22nd. So make sure to tune in to that. All right, final question. We'll go ahead and start again here with Nate. What's one final takeaway for our audience today?
So for all of you business owners, thank you. It's incredibly resilient, our small to mid-sized business owners. So it's impressive how you've hung in there through the pandemic, the things you've done, taking care of your employees. My encouragement to you, think differently. Instead, if you have a choice to make and it seems like you should do X, think about doing something opposite. And 90 seconds to tell you a quick story about drove that home for me. I went to help put a wood floor in my folks' house in Yankton, South Dakota. And a buddy came with me. We took his Ford truck and we put all our tools in the back of his truck. We're in Yankton, South Dakota, population 15,000. The contractor didn't even lock up his tools, but my buddy thought it important to lock his truck while we were working. I had to get a saw out of the truck. So I asked him for the combination. Best thing about Fords is they got that little keypad on the side. So I typed in 12312. That's not his code. Tailgate unlocked. I went back there to open it. And just as I went to open it, it locked again. And I thought to myself, I got to move faster because I waited too long. So I typed that code in, ran back to the round truck. Just as I went to open the tailgate, it locked again. Now I'm kind of cussing Fords, right? So I thought I'll open the door and then shut it and then it'll stay unlocked. So I'll 12312, open the door. It's unlocked, shut the door, go back. Just as I go to open it, locked. Now I'm getting mad, right? And I try this 2 or 3 more times and I hear somebody laughing in the garage. My buddy's in there with the key fob going locked, unlocked, unlocked. But what I took from that is every single thing I tried is something that worked historically. And so often we solve problems through thinking about the way we've done it in the past. Look to the future. Think about what you could do differently. If you normally lower prices in a certain situation, ask what would happen if you raised them. You might get to the same answer, but it'll cause you to think differently.
Thanks, Nate. Tom?
Wow. Okay, so let me build on that idea. Not about the car lock. So you all are in business, right? Most everybody? Yep. So the proposition I have is, if you think about all the major problems in the world, if you believe in global warming, you look at food insecurity, if you look at starvation, not enough clean water, there's pollution. People are fighting over scarce resources, they're causing wars and things like that. You are the solution to all of those problems. And there's a natural order. If we solve energy first and have enough energy, we can get clean water through desalination. If we have enough clean water, we can get more food supplies in the world by irrigation. We can reverse desertification through irrigation. And if we have enough clean water, clean food, lots of people's health problems go away. We know if we raise the standard of living fast enough, the birth rate goes down and population stabilize. People are out there working on the technologies. We need to do all of that. But what we have to have is the resources to do it. As we've already talked, the government doesn't have enough resources. But businesses can aggregate capital and create the resources to enact the technologies that solve all of those problems. So as you look forward, look for ways that you can capitalize on that movement in the world, because I guarantee it's coming. And if you as a business can participate on that, you'll do very well as well.
Eric.
We started today on a real somber note, and I think it's apropos to finish on that note. A lot of the people in this audience know Will, as I know Will Keeps. The unspeakable tragedy that happened yesterday. Go back just a few months in time. I have a senior at Roosevelt, and her prom last year in May, at her post-prom party, and this was south of Grand on Foster Drive, by the way. There was a mass shooting, and 3 students were shot, all of their lives altered, including my daughter's date. It is a human tragedy. It doesn't just affect those that the perpetrators are going away for a life, the victims and their families and their friends. And, you know, this part's going to be tough to hear for some of you, but you need to understand it. In June, on the same day of the Uvalde tragedy, our state government passed an assault ban bill of rights effectively for AR-15s, which are not really good hunting rifles, by the way. And if we give people our thoughts and our prayers, which I hope to God you do, because as a family that's been through that, we need them. We also need your action.
Thank you, Eric. Debbie?
Well, I would just say to keep investing and innovating in Iowa, whether that's in your business or in the community vitality, the place you call home.
Thank you, Debbie. And Don, wrap us up.
Yeah, I would just say, you know, with every interest rate cycle, with every change specifically, what's going on right now and the interest rates going up and down, there's always opportunity in whatever business you're in, whatever, whether it's manufacturing, distribution, commercial real estate, whatever. I think there's opportunity in your own marketplace, regardless of where the interest rates are, and just keep your eyes open, keep looking for those opportunities, keep your revenue and your costs kind of in line with one another. And that's it.
Thank you again, Don, and to all of our panelists. Let's give them a big round of applause. We too are a local small business, and we're evaluating the economy just like everybody else here and working hard to navigate the waters. And I want to thank everyone that came here today to be here, to be part of this, and to hear and learn so that we can all continue working together on our economic future here in Des Moines. To our sponsors, thank you again for making this possible. We couldn't do it without each of you helping power this event. So thank you very much for that. And of course, to our staff, Stacy Thompson, Sarah Brown, Kate Meyer, and the entire team at BPC for helping put this on. It takes a whole group to do that. So thank you to them as well. Again, my name is Chris Konetsky, and our goal always, you hear me say it from every event, our goal is to help you and your business do business better. If our newsroom, our advertising staff, myself can be of any help as you're navigating your business's journey, please feel free to reach out our way. We're here to help you, and we're here to help you do business better in the future. And finally, I picked on a few of them. I appreciate each of you being up here today and giving your best to give us a perspective of what's going to come in the year. Can we get one last final round of applause for our audience?
Thank you. Stay safe, stay informed, and we'll see you all soon. Thank you.